Yield Max ETFs have exploded in popularity recently, and you might have seen people talking about them on YouTube, Twitter, or finance blogs. But what even are Yield Max ETFs, how do they work, and are they something you should be paying attention to? Let's break it down carefully, in a way that actually makes sense. At the simplest level, Yield Max ETFs are a specific kind of exchange-traded fund designed to maximize income payouts, often monthly, by using option strategies on popular underlying stocks like Tesla, Nvidia, Apple, Amazon, and others. The most famous are the ones from the Yield Max brand, like TSLY for Tesla, NVDY for Nvidia, APLI for Apple, and AMZ for Amazon. These ETFs don't hold the actual stocks. Instead, they use synthetic exposure combined with options overlays, usually call options, to generate income. The ETF manager collects premiums from selling options on the target stock, and that income is then distributed to investors, often at extremely high yield levels, sometimes advertised as 30, 40, or even 50% annualized yields. But let's be clear, these high yields are not magical free money. They come with real trade-offs. Yield Max ETFs are designed primarily for short-term income maximization, not long-term capital appreciation. That's because when you cap upside with covered calls or synthetic strategies, you essentially trade potential price gains for cash flow. If Tesla rallies 50% in a year, the Yield Max ETF on Tesla won't capture that rally. You might still get the high monthly payout, but you miss out on the share price growth because the options cap that upside. Another critical point is that these products often rely on derivatives, which means they can carry counterparty risk, liquidity risk, and complexity that many retail investors underestimate. The ETF share price itself can decay over time, especially in volatile markets. For example, TSLA shares might be up 20% over a year, but the TSLY ETF could be flat or even down if the options strategy backfires or premiums dry up. So who are Yield Max ETFs for? They are appealing for income-focused investors who want to generate monthly cash flow, often retirees or cash flow-focused portfolios. But they are not ideal for long-term buy-and-hold investors looking for growth, because you are essentially selling away the upside. Many people misunderstand the yields too. When you see 40% yield, that's not guaranteed. That is backward-looking or estimated annualized yield based on recent distributions. It can change dramatically if market conditions shift, implied volatility drops, or the stock underperforms. Another nuance is tax treatment. These ETFs generate ordinary income, not qualified dividends or long-term capital gains. So depending on your tax jurisdiction, the after-tax return can be lower than it first appears. Let's look at a hypothetical example. Suppose you put $10,000 into a Yield Max ETF on Nvidia. If NVDY pays out a 3% monthly distribution, that's about $300 per month. Over a year, that's $3,600, or roughly a 36% yield, assuming stable payouts. But if Nvidia's stock goes up 50% that year, you won't capture that upside in your ETF NAV because the strategy gave up price appreciation to generate those payouts. If Nvidia drops, your ETF will also likely drop, and the distributions can shrink. So there's real downside risk, even though the income looks attractive. It's important to understand that Yield Max ETFs are still very new, and long-term performance data is limited. Most of them only launched in 2023 or 2024, so we don't have a full market cycle to evaluate how they behave across bull and bear markets. Critics argue that these products are more like yield traps, luring in income-hungry investors with high advertised yields but delivering poor risk-adjusted returns. Supporters argue that if used carefully, in small doses, Yield Max ETFs can be a useful tool to enhance cash flow, especially in sideways or choppy markets where capital appreciation is limited anyway. One thing to keep in mind is fees. Yield Max ETFs tend to have high expense ratios, sometimes over 1%, because of the complexity of managing the options strategies. Compared to a simple S&P 500 ETF at 0.03%, that's a massive difference. So you are paying a lot for that engineered income. Another consideration is liquidity. These ETFs often have low trading volumes and wide bid-ask spreads, meaning if you want to exit your position quickly, you might face slippage. So how should you think about Yield Max ETFs? First, understand your goal. Are you looking for pure income, knowing you will sacrifice growth? Are you okay with complex products that require monitoring and active understanding? Do you know the tax impact in your specific case? And most importantly, are you aware of the risks involved, including NAV decay, fee drag, and market dependence? If the answer to any of those is no, then a Yield Max ETF is probably not right for you. But if you are a sophisticated investor, looking to allocate a small portion of your portfolio, maybe 2 to 5%, into something income-focused and you understand the mechanics, then it can be an interesting addition. It's not a magic solution, but in the right hands, it's a tool. In summary, Yield Max ETFs are high-yield, high-risk income products that use options strategies to generate cash flow, but they come at the cost of upside participation, increased complexity, and higher fees. They are not suitable for everyone, and they are definitely not a replacement for traditional long-term investing. If you want to learn more or get exclusive portfolio insights, check out my Patreon link in the description. Also, check out my favorite brokers where you can trade ETFs like these. BitGet and eToro links are also below. Thanks for watching. Make sure to like and subscribe, and see you in the